Hello, I'm here today with Charlie Gibson, Sector Head of Mining here at Edison. Charlie, welcome. So today we're going to be talking about Silver Wheaton. Could you start off by just explaining what Silver Wheaton does?
Silver Wheaton is the world's largest preeminent precious metals streaming company. It used to be silver only, but now it is precious metals. Interesting to note, it doesn't diversify into oils or base metals. Now, when I say a streaming company, what that means is if you operate a big mine somewhere, say it's a gold mine, it probably comes with a byproduct, and that byproduct is probably silver. And the silver is worth a certain amount to the company that mines it, but probably in the eyes of the market less than it would actually be worth as a primary business stream. So what Silver Wheaton does is it says, we will give you a lump sum in millions of US dollars. We will give you some income in the form, let's say it's silver, as something like $4 an ounce for every ounce you produce year in, year out from now on until the end of the life of operation. In return, what you will give us is that stream of silver as it comes out of the mine. So it's effectively arbitraging, if you like, the value of the silver as it's perceived to the miner and the value of that stream of silver, in this case, as it's perceived to Silver Wheaton. And
so what returns does it make?
So if you look at one particular contract they have on a very large mine called Penasquito, we estimate that over the life of that mine they will get a 16% internal rate of return. Now, you want to compare that with, first of all, their cost of capital, which is cost of debt is about 2.5%. Their cost of equity is about 5% based on the capital asset pricing model. So you can see the difference between what they pay for their capital and what they're getting in terms of their return for the capital is pretty significant. By and large, when they enter a contract, they expect to get a double-digit return, but inevitably the contract won't change, but the life of the mine, the asset, probably will change. Usually what you find is that mine lives are longer than they're projected to be, so certainly at the initial stages. So Silver Wheaton will benefit from that, and that's why you see the contract, or the return on that contract, go up from double digits to something close to 20% by the end of the life of the mine.
So how does an investment in Silver Wheaton differ from an investment in precious metals?
There are two key differences. One is that you get a geared return on your investment. Now that is because Silver Wheaton, let's say in the example I gave you before, they're taking a silver stream, they're paying $4 an ounce. So if silver goes up from $20 to $21 an ounce, they're getting a return which is increased from $16 to $17 effectively, which is larger than the percentage return you get in silver, which is just 20 to 21, i.e. a 5% return. So you get that geared return. And the other key difference is because it's getting a stream of income, it pays a dividend, which of course any precious metal doesn't.
And what's its risk profile like compared to gold miners like Barrick or Newmont?
Well, very significantly different, and in this case very significantly less. The most important difference that they are not exposed to, the most important risk that they're not exposed to, is cost overruns, either capital cost overruns or operating cost overruns. They're not affected by capital costs at all. In terms of operating costs, those are already predetermined by the contract that they enter into with the company that is actually mining the precious metals. So that is a risk they don't have. On the other hand, they do get the principal benefits, which is A, exposure to the precious metal price, and B, exposure to blue sky exploration success. So they get those two upsides without the key downside.
And how does it differ from royalty companies like Franco-Nevada or Sandstorm?
The most obvious difference, it's a slightly technical difference, but with a royalty company, the royalty is connected to the tenement, i.e. the lease area. Whereas in the case of Silver Wheaton, they have an agreement with a company. Now that has both risks and rewards. One of the advantages of that is if something happens with the contract, and this has happened to them in the past, where a company has not been able to fulfill its obligations, they have been able to go back and renegotiate the contract and say, okay, you can't deliver from that mine, deliver from another mine, which is an advantage. If you like, the threat to some extent is if the mine on that tenement area closes down and then stays closed for 50 years and then someone comes to reopen it, Silver Wheaton won't have the benefit of having their contract associated with the tenement because they have the agreement with the company. Whereas a royalty company, because it's with the tenement, if a mine closes for 50 years, someone comes along, and there's a different company and they reopen it, they would get the benefit of that. So it's quite a small technical difference. It is there. Also, typically, royalty companies, they won't have the geared exposure to the precious metal price because they're just getting, say, 2% or 3% or 5%, whatever it is, of the revenue. So if revenue goes up by 10%, they will get a pro rata increase. They won't have that geared effect that I mentioned earlier, where you have the cost in there, which increases in percentage terms, the increase that accrues to Silver Wheaton as a result.
And what valuation is Silver Wheaton trading on?
Well, this is the key thing about Silver Wheaton, is if you compare it to the miners, where we said, look, it has basically all of the upsides that an investor wants in a mining company, but it doesn't have certain key risks. Well, Silver Wheaton basically trades on the same sort of multiples, the same sort of dividend yields, and in some cases cheaper than the miners themselves. And in all respects, in all valuation respects, over all time frames, it is cheaper than the royalty companies, to whom it is actually very, very similar. So it's a strange, if you like, valuation mismatch, where it seems to be being compared to the wrong sector in the market. It's being compared to the operators and not the royalty companies, who are, it's probably, without doubt, its closest peers.
Charlie, thank you very much for joining us today. If you'd like any more information, please visit the Edison website.